So hi, I'm Vedant. In this video, I'm going to share with you exactly why and how I learned to invest in the Indian stock market, and you should too. We know what a market is, but what is a stock? A stock is a very tiny percentage of a company that you own once you purchase. There are two markets for stocks. One is called the Bombay Stock Exchange and the other the National Stock Exchange. Each of these stock exchanges have their own index. An index is a group of top companies. By seeing how the index moves, we can see the overall movement of the market. The index for Bombay Stock Exchange, which is much older, is called Sensex. It comprises of 30 top companies which are listed in Bombay Stock Exchange. The index for the National Stock Exchange is called Nifty, and it comprises of top 50 companies that are listed in National Stock Exchange. To invest in the stock market, we need to understand compounding. Let's recall compound interest with a simple example. Let's assume you have 1,000 rupees and you earn 10% compound interest on it every single year. The interest earned for the first year will be calculated by taking 10% of 1,000, which is 100. So, the end of first year you have 1100 rupees. The interest for second year is then calculated by taking 10% of 1100, which is 110. Therefore, at the end of second year, you're left with 1210 rupees, and this process continues. Let's come to what compound interest has to do with the stock market. Well, the Indian stock market, or Sensex, in the last 40 years has given us a compounded annual growth rate, or an average compound interest of 16.1%. Please note here, average compound interest and 40 years are keywords. I said the keywords are average compound interest and 40 years. This is because if you take a time frame of even 2 to 3 years, you could have made huge profits, losses, or not made much of a difference. But if we take a step back and zoom out and consider a 10 to 15-year time frame, it is safe to assume 16% compounded returns. Holding stocks for a short period of time is extremely risky and called trading. Let me share a clip.
I know what markets are going to do over a long period of time. They're going to go up. But in terms of what's going to happen in a day or a week or a month or a year even, I've never felt that I knew it, and I've never felt it was important. I will say that in 10 or 20 or 30 years, I think stocks will be a lot higher than they are now.
Well, that right there was Warren Buffett, the world's most successful investor. His net worth is exceeding 70, wait for it, billion US dollars. Let's see a compound interest in action. Let's assume you have 1,000 rupees. I know it says dollars, but assume it is rupees. The calculation doesn't change. An interest rate of 15%. We have taken 15 because ideally it is 16, but realistically you get less than that. We are compounding annually for a 10-year time frame. Guess how much it must have become? That's right, the money has become more than 4 times itself. Isn't it amazing? But something even more interesting happens when I just add 5 more years. Let's see what I'm talking about. The money has become 8 times itself. But what I'm trying to say is, it took you first 10 years to earn a total of 3,045 rupees of interest. But it took you only 5 more years to earn 4,000 rupees of interest. This is how compounding works. It grows exponentially as you give it more time. Something that has to be appreciated is you haven't done work to earn this money. The money you have invested has done the work for you, just for fun. To see the power of compounding, let me take a 40-year time frame to see what happens. I think I'll let that speak for itself. Making short-term, high-risk investments are called trading. To give you a hint of how difficult it is, let me share a clip.
That's why out of 1 million traders, only 90 or 100 really make money.
That was Rakesh Jhunjhunwala, a man who turned 5,000 rupees into 19,000 crores. So, let's come to the big question. Why do majority people lose money in the stock market? Which is true. Well, people invest large sums in individual stocks without thorough or any research. Let me explain with an example. Until very recently, Vodafone and Idea were two telecom giants. Out of nowhere, Jio came and wiped the floor with them. People react strongly to news, which is often noise, without understanding its impact. People try to predict the near future. These are very natural tendencies and can be overcome often only by making mistakes in the beginning and gaining experience. Hence, it is best to start early and small. The question then arises is how to invest? Well, do not put all your eggs in one basket like we saw from the example before. Invest small amounts consistently in a Nifty 50 index fund for long term. That led us to the second question. What is a Nifty 50 index fund? Well, Nifty 50 is a list of top 50 companies in the country spread across 13 sectors. Example, automobile, financial services, pharmaceuticals, and information technology, and so on. You can Google the remaining. It would cost a person more than 70,000 rupees to purchase every single stock listed in Nifty. Hence, we have large funds in which many common people invest. A fund can be as large as thousands of crores because many people contribute. Since the fund has so much money, they can buy Nifty consistently on behalf of us. The fund charges a small fee, less than 0.3% generally, depends on the fund, of your invested amount as commission for having done the work for you. Because of such funds, we can invest a fixed amount every month starting from as little as 500 rupees. This is commonly called Systematic Investment Plan or SIP. The Nifty 50 is revised by a government regulatory board every 6 months to ensure it consists only of the 50 largest companies, which may change. Large successful companies cannot grow at the same rate as a small company, which may double, triple in a span of couple of years or go bankrupt even quicker. So this is the graph of Nifty 50. On 1st Jan 1999, if you had invested 100 rupees, in the recent November of 2019, it would have exceeded 1200 rupees. And if you even include the crash that we are going through right now, it would still have exceeded 10,000 rupees. So here we can clearly see it's just a game of patience. The longer you stay invested, the more you see the fruits of it. Trading is very exciting because of the high risk and potential to earn quick money. It is much like speeding in the sense there are professionals who can do it, but if a normal unskilled person tries it, one may do it a few times but very soon hurt themselves very badly. Even professionals meet with horrible accidents. You also end up hurting others around you by sharing your experience and setting fear into them about the stock market. To start investing, you require a demat account, broker, and a bank account. A broker is a man who actually buys and sells the stock for you. We are only there to give the instruction. All of these can be done through apps today. Apps are becoming more regulated and popular because of convenience and low commission. You can research the apps that exist and select one, or if you do not feel safe, you may find and contact any brokerage company or office. I realized investing has a lot more to it than just making money. I learned to grab the opportunity when it presented. I began investing because of the recent crash caused by the pandemic, which is the best time to invest if you observe the graphs. Believe it or not, by investing in Nifty during a crash, you would be investing in the economy, helping it boost, which it is in desperate need of. I am learning to manage risk, which is extremely important. I also ended up learning to edit a video to some extent so I could share what I learned. I tried my best to inform more young people because they are the ones who can benefit the most. This lockdown, I realized how I have mismanaged money until now, like most people my age and also older. If you think of it, we have practiced it for almost all our lives, especially teenagers and college students. The chance that we will learn to manage it magically on the day we get our job is highly unlikely. I'm not saying I will never watch a movie with my friends, but I will make sure the ticket is the biggest expense. It's great if you're still not convinced by everything I said, as long as I have piqued your interest enough to go dig into it and get to the bottom of this. If you found this video useful, make sure to smash that like button, share it with your friends. You should also consider subscribing because I'm going to upload another video in which I'm going to discuss all the parameters that need to be analyzed before selecting your index fund, as it can be confusing from all the given options. And also tell you the one that I chose. Until then, stay safe.